record certain things so they know how to adjust their trading plan as market conditions change. Because you're going to have insanely volatile markets. You're going to have, nice, just trending markets that are moving, and you're going to have markets, which usually happens, by the way, when markets are at tops, okay, at highs, and a lot of markets making new highs, you'll get markets. And that can be a really good thing or a really bad thing. It's a bad thing if you try to trade a flat market that's at its highs like you are a trending or volatile market. Like, does that make sense that you have to change up your plan a little bit if things are moving slower and not as far? Does that make sense to everybody? Like, you can't just trade the exact same way all the time. So yeah, Chip, pull out a different club. Exactly. And as traders, we get we get into something, and I've done this probably, I don't know how many dozen times before I started to figure it out, mainly through a trading journal. But we get into this thing where we're rocking and we're doing really well, and let's say we're staying very disciplined. Okay, we're using our risk management, all that, but we're not paying attention to the bigger view of the market. And so we just keep chugging along thinking, I'm going to trade the exact same way as if the market's just flying and trending everywhere. And, that's not going to work. An example of you that know me is, my daughter is a barrel racer. She's won 12 world championship titles and dozens of other titles and all that. And she's 10, about to be 11 years old here in a week, and just loves it, lives it, everything. But one of the things that she's had to learn is how to adjust. For instance, let's just talk about arenas. Everybody can visualize an arena in a big box of dirt, right? If you go into an arena that's only, say 80 feet wide, then you're going to have a much smaller barrel pattern. A barrel pattern is basically just a triangle, and you run around in what's called a cloverleaf pattern. Or you can have a full-size WPRA, Women's Professional Rodeo Association arena, and it's 130 feet wide. We're actually building our arena to be 130 feet wide. That's what I'm working on by spring. And if you run a horse the exact same way when you're only running, say, if it's 80 feet wide, so you only got like 60 feet in between your barrels, as when it's 130 feet wide, and so you have 90 feet between your barrels. If you try to run them the exact same speed with the exact same timing, you're not going to do as well. Like, you got to rate sooner because you're not going to go as far. You know that. I'm only running this many feet, and then I'm going to turn. Whereas you can open up a little bit more on a bigger arena because, you're going to go further. So, you basically, let the horse run at full throttle. You don't slow them down. She also has different horses. Okay. So that's like market conditions. And also the dirt can be different. You can go to some places and the dirt's like sand. Other places it's clay, which can be really hard. One's really soft, it can be slick, or you get a really good one that's a nice combination of like 80% sand, 20% clay. And so if it's really hard, you have to run slower, like not go full throttle, because the horse is going to get speed just by getting full contact and thrust right off of the the ground when they run. And they're going to have to rate a little sooner because it's so easy to go fast. If you're in deep, good clay, sand, like the good combination, you can go all out. If you're in pure sand, it can be slick. So you can go pretty fast, but you also got to rate because otherwise your horse is just going to slip and can fall. So you have to adjust to the different arenas. Size, sand, stuff like that. Indoors, outdoors, all sorts of things can impact it. Well, that's market conditions. The next example is she has like 10 horses. And 5 of those are barrel horses. okay, which means they run, their main job is to run the barrel pattern. Some of them, she literally can run with her legs, like doesn't even need her hands. Others, she has to really use her hands and to turn tighter just because the way that they move. And it's very difficult. It's an amazing thing that she's learned. It's helped her actually become a much better rider than competitors that have one horse and they've had the same horse for 5 years. You know, she's sold several horses and had to adjust to a lot of different types of horses. You have what's called free runners, where you don't really even need to touch them. You just point them in the right direction and they go. So you have push style horses where if you're not kicking, they're not running. You have automatic horses that know their job, and you can basically just close your eyes and hold on, and they'll do the thing. And you have other ones that are like, tell me where to go, and I'll go. Tell me to hit a wall, hit a wall. Like they don't really know what they're doing, but they listen really well. You have other ones that are just, pains in the butt, right? And so one of the reasons she sold some horses is because they were difficult, they were pain, they were nervous. You always got really nervous riding them. You could just feel the nervousness energy. We sold those horses off. The ones that required a whole lot more strength and were really difficult to run, we sold those off. The ones that didn't have enough speed, we sold those off. Okay, it was really challenging because like one of our horses, whose name is Comet, Doc's busy man. He has this great line. He's made her, I don't know, over $10,000, one of all sorts of awards. And she just, this horse was her big step-up horse. Like after she got her horse that knew everything, but would let her like walk or run, then she got this horse, which is a full free runner. I mean, literally 2 steps, full throttle. And she had to, decide. And it was difficult, but she had to decide, do I love my horse? Not horses, but do I love this horse more than I love, winning? Right? I mean, she's out there to make money. And this horse is a little more difficult to ride for her just because he's so powerful. A few years, he'd be a lot easier for her. But right now, just a lot. He's very powerful. And she has other horses that are younger, that are more powerful. And when she ride this horse, she'd have to use a stern hand. The other horses, she doesn't. And so she'd go do that race, and she'd be like racing, let's say 3 of them at a time. Well, she ran the ones that didn't require a light hand. Then when she ran the one that did, she wouldn't use enough hand to turn, and she'd go too wide. Or if she ran the one that required a hard hand and she went and ran the one that didn't require a light hand right after that, then she'd, pull too hard and too soon and hit the barrel, which is either a penalty or a disqualification, depending upon the type of race you're at, if you're at a rodeo or what's called a 5D jackpot. So she had to make a decision, and it was really hard because, this is her favorite horse to ride bareback. Everywhere we went with this horse, people were like, wow. Like, he just looks gorgeous. He's huge. He has zero fear, easy horse, hops right in the trailer, easy to do his shoes, just zero problem. I've never had a vet, like an actual real vet bill on the horse. He's 18, he's awesome. And, but she had to decide if she wanted to keep riding him because he was the safety net, or if she was going to branch out and focus on some other horses. What does that have to do with trading? Well, sometimes we fall in love with a market and we get in a mindset, and there are other opportunities that we could be taking advantage of. But this is comfortable because I know this. I've had success with this. And yeah, I may not be getting the success I want right now, but I've had it. And since I've had it, I know I'm going to have it again. That's our mindset. And I don't like having to go and learn a new market or learn a different way to trade. And so we hold back. And that actually, her trainer said that she was like insanely impressed that she decided to sell the horse because he is a great horse. But it's time for her to go to another level. And she decided to go ahead and, move forward and sell him. You as a trader, and tell me, who in here has fallen in love with the market? And here's a sign of falling in love with the market. I trade NQ. What have you traded for the last month? Last 3 months? NASDAQ. Who in here who meets that? Trade like one market. And that's all. And I'm not saying it's a bad thing. We're going to talk about why that's good and why it's bad. But who in here can tell me that's like basically focused on one market and that's all you looked at? Stuck on CL. A lot of people, okay, there you go. Wow, Jonathan. So Jack, yeah, you've done well. You expanded out to 5 markets. Bernard, oil, Aussie yen, NQ, 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 NQ. Okay, so part of that is one of the things that we train you, and we train you on purpose, is to focus on one market, right? Like in power plays and stuff, one of the things we want you to do is focus on a market. Does everybody remember that part of the training? Why do you think we said focus on one market when you're beginning the training? What do you think was the reason for that? So Matt established a foundation, Chip get consistency, Greg to learn inconsistent or intricacies, Kenny to not get overloaded, Ozzy to get familiar, learn the behavior of the market, Raphael, Easter learn one versus multiple, Jonathan, so we didn't get over our heads, Joshua, so we can focus, Cash, know that market, Mike, able to notice patterns, Abel, learn how it acts, Robert, so we can get good at it, less distractions, Lau, Ozma, focus on NQ to learn the power plays, Jim, to recognize changes, Adrian, reduce the number of changing variables, learn the basics, Lori said so, yeah, that's probably the biggest one right there. Lori says it, then I say, yes, ma'am. Lori's awesome, isn't she? I just got to give her like so much like props. So she does, like, I don't know if you all know, a lot of people don't know this. They think that Lori like works for Apex. Do y'all know that she doesn't work for Apex? That she literally is just a trader. I don't mean just in a bad way, but like she's not an employee. She receives no like we don't send her cash. Like she came in and asked a bazillion questions, which is why we're always telling you ask questions. And over time, she developed it. She learned it. She actually was able to help me take a lot of the things that I do and help me make them more objective so you can see them. That's like where a lot of the power play things have come from, stuff that I see just because I've done it for over a decade. But that's one of the reasons for the tools. People always go, why do you need tools? Why can't I use free tools? Why? Well, because it's easier. It's more objective. One of the things I'm having to learn right now. First, I just want to say like total thanks to Lori for everything she does. And I remember like she literally is just volunteering her time to help out traders. And when she first came in, she didn't know what bid offer spread was. It's awesome. I mean, she's went all the way. And I remember her at Christmas. But she's learned to adapt and go through things, and she's helped out a ton. So as traders, we started off. I sort of got a little off track there, so we give her kudos for everything that she does, night and day. We get stuck on a market. Part of it, pardon me, get a drink of water, is due to, that's the way you were taught if you started out with us. But you have to progress as a trader. Does everybody agree with that? Like you can't just stop learning in anything. And you have to learn how to use, tools, new tools. Again, another ranch example. You'll probably hear a lot of these each time I do webinars. But like one of the things is, like I said, I'm expanding our arena out 35 feet. So 200 feet wide, 270 feet of pipe fence, oil pipe fence I got to put down to expand the arena out. And I could just hire somebody to do it. I actually enjoy doing work outside. It's my stress reliever, riding horses and doing stuff outside from, trading. Trading isn't that stressful, but it's just, I just enjoy it. And so I could just hire somebody to do it, but I decided I'm going to learn how to do it. And so I've had to learn, and I got a whole, finally, like I was asking, I was watching all these videos online and people having all these different things to say, and got a hold of one of my friends, and he actually is the guy that shoes our horses. And his dad is a welder. He's a huge welding company. And he's like, call my dad. He'll help you with anything you need. I call him up. This is literally last night. I call him up, and I'm like, okay, I'm brand new to welding. I'm watching the videos. I'm learning how to do it. I'm actually planning on going to a local community college course. You know, it's sort of funny. I'm going to this community college course to learn how to weld. But just because I want to learn how to do it. And the thing is, as I started looking to do this, I was like, what tools do I need? And so I had to learn how to use even what tools I needed. And he was telling me, if you use this, it's going to take you 5 times as long. And so he told me what tools to use, what tools not to use. So it's very important to have the right tools to help you do any kind of profession, whether it be welding or trading. Okay? All right. So with all that being said, let's look at some ways that you can take advantage of the market. Okay? And let me get down here. Now, I am at a disadvantage because I don't have my full supercomputer set up. But while I'm waiting on that, what I want to do, oh, come on. There it goes. It's working on loading. It's waking up. So I want to show you something. What happens? Who knows what implied volatility is? Let's start off there. There we go. Expected movement of the market. Perfect. So it's not quite like expected volume. That's why that's not loading. I don't have it open in the background on this computer. I'm sorry. I'm going to open this up. You have to bear with me. I'm working on, got it all rigged up here. So implied volatility is expected volume. Now, who's heard of the VIX? Anybody heard of the VIX before? So we got yeses, kinda, no, yep. Some people call it the fear index. Okay. Who can tell me what the VIX actually is? Like, what is the VIX? Like a definition of it. It's a volatility index of the S&P 500. That is correct. And it's measuring the implied volatility of the options. So it's a forward-looking, people putting their money where their mouth is. Look, it's actually, we use implied volatility. Like, we don't use the VIX, we actually use the ES options. But for like ES, we'd use the VIX if we were looking at SPX. But the VIX is that just common indicator that every trader should be aware of. Okay? And let's see here. And so, like, okay, so the VIX is a volatility pricing index. It's forward-looking. It's the fear index. When it's high, fear is high. When it's low, greed's, in full throttle. Or there's no fear, at least, lack of fear. Black-Scholes options pricing model, all that. How does that help us? Like, knowing what it is one thing, but how does it help us? gives us an idea of expected volatility. Yeah, we use that for our deviation implied. We're not using standard deviation, which is backwards. We're using implied, which is forward. Gives you a little temperature of the market. Help us price options. So everybody's on really the right track. Let me go over here. Now here's the big thing that most people miss. Okay? And, you know, Mike, you were, I'll make sure I got the right, give credit to the right person. And by the way, I never stay on track. I'm always going, like, if you've been on my webinars, don't expect them to be like 1 hour long. Okay? Sorry, but so I'm just going down to get back down all the way to the bottom. It'll be very interactive, which is awesome. Michael. Okay. Yeah, Michael W. VIX low buy options, VIX high sell options. That's massive key. Okay. So what I'm going to do is I'm going to pull up a chart of the VIX. I want to show you something that you may or may not be aware of, and then I'm going to show you how to use it in a way that is like why I actually like volatility. Okay. And this won't be insanely complex, so don't worry. If you're like, okay, you know, I'm trying to get the questions out of the way so I can actually see the options on the chart. Let's see here. I want a 10-year chart. Give me that. That'll work. Okay, there we go. It's starting to load up. It's just taking a second because I understand I'm running like go to webinar. I'm running all this stuff, and I'm not on my direct connect plugin yet up at my house. So I'm on a Wi-Fi. Our big O RV at the moment while we were redoing it. Okay, check this out. This is a 10-year chart of the VIX. And what they do is they basically take the at-the-money calls and puts of the front month and the back month, and they take the implied volatility of all four of them and they average them, and that's how they come up with the VIX. That's, you know, the short answer. It's a little more complex, but that's pretty much what they do. So it's just an average of the expectation pretty much over the next 30 days is how they do it. Okay, this was 2008. You know, everybody sort of remembers that, right? And everything went crazy. Okay. But look at where we're at now. We're in like the 9s and 10s. Okay. So a lot of times we're up at, you know, 15, 20, you know, like that's when you're getting a little more volatility. So, you know, you're hopping along, you're thinking life's awesome. And then the markets change on you and they get lower and lower and lower. You're going up to 16, 14. That's even, you know, just here in the past month. And now, like, you know, 11 would be a high number. Okay? What that means is implied volatility is low, which means hedge funds aren't like putting on an insane amount of options to hedge their positions. Okay? Mutual funds aren't doing that. Big traders aren't buying a lot of options, meaning they don't have a lot of fear. That's why it's called the fear index, because they're put on options to hedge stocks, futures, forex, things of that sort. But it's really low. Okay? So, if it's really low, implied volatility is really low, who can tell me, okay, there's 5 Greeks. So I know this is going to a little bit advanced, but I'm trying to help you all go to another level to learn how to trade in different markets so you can fully grasp and appreciate this. And when we're done, this will be one of the most powerful things you've ever learned, period. This is my favorite strategy, period, in trade, not system, okay? Like system is your rules for entry and exit, and stop and trail, and profit. This is a strategy, like how I choose what instruments I trade in the market conditions. It's my favorite one because the risk is so low and the profit could be so high. All right, and it can remove the stress. But what are the 5 Greeks? Who can, or at least list the ones that you know. Like, and if you don't know any, that's okay. You don't have to know this. I'm just sort of doing a temperature check on who we got. Arnold got all 5. First one. Good job. Crickets in my head. There you go, Chip. Yep. All right, so we got delta. Okay, I'm going to explain these in really easy to understand format, okay? Delta is, let's say you have an option on, say, Apple stock, okay? And you buy a call, which means you think the market's going to go up. Expect like if you just bought the call. If the delta is 50, okay, then that means that the option will move at half the speed as Apple. So if Apple goes up $1, the option will increase in price by 50 cents. Does that make sense? That's all delta means. That's like the entire definition of delta. Okay? Theta, or let's go to gamma. Now let's say Apple moves $1, and the delta was 50, and so the option, let's say it's priced at $3 or something, and it's now priced at $3.50. Gamma is the delta of the delta. So it's how much will delta change with a 1-point move in the underlying. So if Apple moves $1, then the delta will go from 50 to 60. So once it moves up $1, and that contract went from $3 to $3.50, if it moves another $1, now the delta is at 60, so it'll move $3.60. So it'll move, it'll more mirror the market. If you get a delta of 100, then that means the option is moving the exact same speed as the market. And so like on spreads, for example, you have a delta of 50 if you're at the floor ceiling. It's low, meaning, so like it'll only move at half the speed. If it's above the ceiling or below the ceiling, the market, it's going to move even slower. If it's right in the center, it'll move at 100. That's why we always say trade the daily spreads near the market, because you get that full 100% delta move, and you have more room before it slows down. The gamma slows it down. Okay. Then you got rho, which is interest rates. We don't have any interest rates, so it doesn't really matter at this point. If it ever gets back up to 5 or 6%, we'll talk about it. And you have theta, which is time decay, which is your premium, as you'll hear us talk about a lot. And that's just the insurance premium. Like when you have a car and you got to pay, say $35 or $40 a month premium, that's just money you're paying. So if the wreck happens, you're covered. It's just time value. If it's the first of the month and I got to pay, let's say $40, but let's say I start my insurance on the 15th of the month, so they only charge me $20. So they're charging me time. Okay. Again, very simple overview. The last one is Vega. It's the most important. Vega is based on implied volatility. It's how much does the contract change based on implied volatility. So if IV goes way up, then a contract price will change really fast. If IV goes way down, contract price will change slower, just based on IV. But if IV is low, then theta is cheaper. Okay, so premium is cheaper. What that means is you can buy really, really cheap options. Okay? Now, some of you are like, oh, I don't trade options. Some of you do. So I need to get it to really to be able to explain this the best way I can to the couple hundred people we have on. Please tell me what you trade. Like, you can say Nadex, futures, Forex. When I say futures, I mean like you trade the futures contracts. Forex, you trade the Forex contracts. If I say Nadex spreads or Nadex binaries. Or if it's all the above, you know, great. Whatever, I trade everything. All right, so we actually have Nadex, stocks, futures, binaries, spreads. So a little bit of everything. That's really good. And this isn't like a Nadex webinar, okay? But I do want to teach you something that's going to blow you away. It's what blew me away and made me fall in love with it. Those of you who don't trade Nadex, can you tell me why you don't trade Nadex? And I'm not saying you should not trade futures and Forex. I didn't stop trading futures and Forex. So I still trade futures and Forex. But can you tell me why you don't trade Nadex? And I'm not going to say, and I want to say specifically Nadex spreads. Is there a reason for it? Haven't got around to it. Don't like it. Seems too complex. Time runs out. Blew my first account. Well, that's like falling off a horse. If you don't do that, you're not a cowboy. If you don't blow an account, you're not a trader. Seems really complex. I don't have any reason. Proximity is too expensive. Premium, you mean? Okay. Never considered it. All right, so let me show you, and this is literally the first strategy I came up with, like, with Nadex. And I was doing I'm speaking in Vegas here in just a few weeks, like on November 2nd or 3rd, Thursday there, about implied volatility. And I was doing another expo like that here in Dallas. Nadex was here. My daughter was 3 at the time, comes over and like pulls her head over the fence, like the booth at Nadex. You know, she's just walking around and they're like, hey, do you trade? You know, joking. And she's like, yeah, I trade. And they're like, okay, what do you trade? And she's like, I trade the SPOOs, you know, which is the floor traded term for the S&P 500 futures, because I've been training her to trade since she was 3. And they're like, well, why do you trade? And she's, to compound my money. You know, they're like, who's your dad? She's like, yeah, it's that big booth over there. And so they came, they got me, and they're like, hey, can we talk to you? And they're like, if you could train a kid, maybe you can help out, because there was like no education on Nadex, like 0. And so I had to figure it all out. And I told my wife, I was like, you know, I think I'm gonna become like the expert at Nadex. I love options, I love futures, I love Forex. Nadex is all 3, you know. And so I got into it, and I mean, I drilled it for like 4 hours to see if this was like, you know, some scam thing or something real. Was insanely impressed. And then they asked me to speak in New York, and I had this presentation, but sort of a, you know, short version of what I'm going to go over with you today. And I mean, the room was packed, but we didn't have this kind of volatility. Like with IV wasn't this low. Okay. And so I taught this, and literally, I mean, like the room ran it, because I'm like, hey, go get a demo account now. And I mean, there was over 100 something people that signed up for a demo account in Nadex. So the first step I'm going to do, and again, I'm promoting Nadex, so I'm not trying to promote Nadex. Okay, I don't get paid $1 whether or not you trade contracts on Nadex. Okay, like if you don't trade or do trade, if you trade 1 million contracts, you trade 1 or you trade none. It's not like Nadex is going to go like compensate me for that. I'm not registered for that kind of thing. So I just want you to know this isn't me like selling you on it. I want to show you why it's so powerful. So one thing I recommend you go ahead and do right now, okay? And it's not going to hurt you, and it's free. All right. If you don't have an account, 1, get a demo account. All right. So it's free. Just hop on over to nadex.com. Yeah. You can click out of that. You don't need to fund it yet till you're ready. Then go down to, on trading platforms, go down to demo trading platform. And when it fills all in, fill in your information and get a demo account. Okay, and literally like right now, just go ahead and do it. It'll take you 2 minutes, and that's if you're a really slow typer. Okay, if you're going to do it, pecs with their fingers on the keyboard. So go ahead and do that just so you have access to it. It's free. It costs you nothing. They put $25,000 of funny money in there, and you'll be able to actually play with this, what I'm going to teach you. So let me go over and see if I can actually Ninja won't blow up on me. We've all been there, right? Let's see here. And I'm just going to open up, let's see, everybody said NASDAQ. So I'm going to open up NASDAQ. I'm going to put it on daily bars for a second. That should not take too long because it's daily bars. There we go. And then we'll just squish it on back here. So we've obviously been making highs. And what we have right now, you can see we've had, I want you to understand, this isn't like new. This isn't like a thing you use one time. You can see like right here, it's really tight, trying to make highs for like a week, not doing anything, okay? We had the same thing over here. And I want you to maybe pick up a little pattern, hopefully. But when you're playing like right at a high, like what happened right there? Let me see if I can turn my crosshair on so you can see what I'm talking about. Right there. What happened after you played that little chop high? What happened with the market? It fell. And over here, wasn't as tight, but it was still pretty lame for a week. Had a drop and then lame, and then boom, another drop, flew up, waiting for it to drop. Right here, like we had a whole week right there, boom, dropped. Okay, by the way, when the drops happen, the implied volatility goes up. Okay, so options get more expensive. You see over here, drop. Doesn't mean it's going to keep going down, it just did. Okay, so one, don't be shocked if the market decides just to go ahead and drop 200 or 300 points in a day. And that sounds crazy right now because of what we've been feeling. But compare, let's see here, give me something. What can I? Do that box again. Here we go. I usually have that on my chart template, but if we look at this right here, finish to always on. Stay in draw mode makes life a lot easier, by the way. If you're trying to draw a bunch of stuff, you hit stay in draw mode, you can do it again and again and again. Yeah, there's a nice trend. And by the way, this is this year. Okay, so this is, again, daily chart. And all I want you to see on this, okay, is how important it is that you learn how to take advantage of this, because it's going to happen again and again and again. When the market's doing this, it's really nice. When it's flying up and down like this, you got some nice volatility inside those days. Those are 100-point days. But when you're getting this low implied volatility that we're getting right now, then it can seem like torture, and this is where accounts can get wiped out. This is where traders often quit. But this is going to happen. You're not always going to get either big volatility or consistent trends. You're going to have this stuff. So it's very, very important. Y'all understand why it's important that you learn how to trade this well? Because, that's a good chunk of the year. I'd say at least, what did I say, 20% maybe? Could you wipe out an account in a week if you didn't adjust to the market conditions? Would that be pretty easy to do? I mean, you shouldn't, but if you're using the 5% rule that I teach, but just looking at that right there, do y'all see? I heard one person, Lau, say yes. Do y'all see why you have to learn how to trade when the market goes flat? Okay, and what do you look at? Who can tell me what you look at to see when it's really, truly flat? Not just the chart, because the chart's always backwards, right? What can you look at that's forward-looking? Okay, implied volatility, and what specific implied volatility for the market? The VIX. VIX is the simplest one, okay? Now, the cool thing is the CBOE, now you have to have the data subscription, or you can go and at least look at the historical charts on the CBOE's website. I mean, that's what I did, like right here. I have the data subscription, but just not on this computer. But they have volatility indexes for the Russell, for the NASDAQ, for the Dow, for gold, for oil, for Apple, like for for bonds. They have all sorts of VIX indexes. So if we go here to, let's see, volatility indices, check this out. I'm just on the CBOE's website. And what I did is I just typed in CBOE VIX chart. But you can go down here and check this out. So this is something this is one of those, like, let me check this in the morning and see where things look. Like, add it to your morning checklist. And don't overanalyze every little bitty, like, half point move and 1 point. But I mean, the thing flies up 5-6 points. It's a different day than when it stays at, like, when it's down at 9 and making like record lows. We're literally at record lows right now on the VIX. So now I can see right here and the numbers compared to each other don't mean anything. You have to look at each one of them. But there's NASDAQ for your NASDAQ 100, Dow Jones, Russell. Okay, I really don't use any of these. There's some ETFs for those who trade, international markets. You got your interest rates, your treasury notes, and even if you trade bonds, that's obviously very helpful. You got oil, you have gold. So definitely things that you should be, and they're ETFs, but still you should be, checking them out. And then, I mean, if you're a stock trader, we had some stock traders, Amazon, Apple, Goldman Sachs, Google, IBM. So you don't need to check everything, but you do need to look at what you're looking. You need to know, are the options cheap or are the options expensive? Because if they're cheap, there's a lot more people that are going to be active in the market. If they're inexpensive, there's less activity. Grant, why don't you send a ticket in for John, addressed to me and John, about I could do a webinar on gaps and probabilities, and that they'll get filled and all that stuff. So I got to stay on track, or I'll be here for, you know me, I'll be here for like 6 hours. But yeah, so Mike, to answer your question, the NASDAQ, VIX, the NASDAQ volatility index, because technically the VIX is the S&P 500, but I knew exactly what you meant. Yeah, you can look at NASDAQ. So the S&P 500 is the second most traded market in the world next to the Kospi, which is in South Korea. It's their index. U.S. residents can trade it, but it used to be illegal, so most brokers haven't built in the back end to be able to manage it and deal with all the FX conversion. Question, is there a VIX for Forex? There didn't used to be, but now there is. So they started them last year. So you actually have a nice range there, and you got them on the euro, the yen, and the pound, and then there's like an ETF that's euro currency. So you actually have a few of them you can look at. And Mike, good question. What's an expensive range? There's only one answer to that, and that's look at the chart. So if we go over, and I know we have NASDAQ traders. There are a lot of NASDAQ traders. And it even tells you what the symbol is. So VXN. If y'all have like a free Thinkorswim account, like I always tell people to go get a Thinkorswim account for free. I love their platform for options. It's just, I'm not a fan of their commission rates. I'm not a fan of how they don't do true tick volume and true tick data, all that, but I love exploring it for options. So anyway, so we go over here to VXN, that's the NASDAQ. Okay, and I just go, I click on the 10-year, and so I can see definitely what's high, 40s, 50s. And I go over here, like, we're not at record low on NASDAQ, but we are definitely, like record low looks like, if I'm on the right bar, like 11.9. And we're sitting right at like 13. But what I like to do is sort of go, okay, well, what can I draw a line through? It probably hit almost every bar. So if I go like right here, where I can hit just about every single bar, besides the extremely highs and extremely lows, like 80%, then we're looking, like if I put a simple moving average on there of 200, okay, then I'd probably get 20. All right, and it might even let me do that. Let's see if I'm right. So advanced chart, let's see if it lets me add anything to it. And this is just, it's so important. It's sort of a next level trading, but it's not hard. It's just looking at it. Their advanced charting is pretty non-advanced. Do a line, it'll be cleaner. There we go. Yeah, that lets us see it a lot better. So right now we're over, 13 and a half. But if you look at 20, if I could, like I said, if I could add a moving average to it, you can also, like I said, you could do it on Ninja if you have the data feed, or you can do it on Thinkorswim. Go to TD Ameritrade Thinkorswim, sign up for a free account, and go through and do an application for a live account. Then you have to fund it, and boom, you have like all the data you want. Okay, which is good for stagnant data, not the data you want to use for live trading, in my opinion. But I used it for years. So, but anyway, so about 20, I guess the number you can draw everything through. So we're down at 15. We even had lows of like 12 recently, and it looks like the lowest low over here is like at 11.42. So I mean, if we're getting down to 12, like we're a point off like the low of for the last 10 years. Okay, so expensive is going to be these massive spikes, like 35, 40. That's when premium, you're going to do everything opposite of what I'm talking about. But and we've done webinars on that. Sharpie has learned how to master a lot of that. But this is the opposite side where it's cheap. Okay, does that help answer your question, Arnold? For there is a FX one, and even if you trade a different currency pair. Like let's say they only have euro and pound and yen, and you trade, I'm just trying to come up with New Zealand peso, okay? Either way, like it's FX is FX. It's one big spider web. Every single currency pair is tied to another, like literally. Like the 200, last time I checked, 212 currency pairs. They're all tied to each other. And it's sort of like the indices are tied to each other because they share so many of the same stocks. So you're certain to see the same pattern, but you could, if you focus on a market, but whatever market you do trade, find something similar to that: oil, gold, ES, Nasdaq, whatever, FX. So treasuries, and just look at this volatility index here on the CBOE, free, and it lets you get that idea. Okay. So now we know. Options are super cheap. Why do I care? Maybe I don't even trade options. Okay? I don't have that Nadex account. I'm still thinking about whether or not I should fill out the demo that Daryl's talking about. So, logged into my Nadex account. This is my demo account at the moment. And just waiting for the cash. And I know I'm sort of breaking the rules and put everything like in its own. Let me tear it out. Google released, this is what made by the way, the plugin a pain. They released an update that when you weren't on the tab, which I mean, it makes sense. It would be nice. Supposedly you can turn it off, but you can't really turn it off. But when you're not on the that tab of Google, then it basically stops the data. And that's why things seem to lock up, and that's why you always need to have Nadex in one tab and the scanner in another. Now, we're going to look at options, and again, see why we care. Everybody in here said they trade futures or Forex or stocks, so you can do the same thing on stocks. And I'm going to go over here and let's just pick the number one thing that was brought up, and then we'll look at some of the other ones, okay? One of the things that came up was, I don't trade Nadex because the premium is so high. Well, that is a true statement. When is that a true statement? Who can tell me when the premium is really high? Like the proximity is far away. So who on here can tell me when? Make sure my mic's working. Good. There we go. That is the answer, Cameron, I was looking for. Okay. When there's high IV, you know, John, Benjamin, Elvis, Tamara, exactly. Okay. So yes, it also is true when they're out of the money, you know, for news announcements. But out of the money, it's not that it's high. It's just all premium. Okay. Before news announcements, your IV goes up because there's expected movement. And you'll notice, like, there'll be a news announcement that's going to happen like at 1:30. And the options that expire at 2 or at 1, okay, are really cheap. And the ones that expire at 2 are a lot more expensive. And it's not because of time. In that case, it's because of what's going to come out. So it also could be because of just time, because that's the theta that impacts the implied volatility. But we're going to go over here, and like I said, we're going to look at, turn $0 off, and hit Control plus. Trying to anyway. What is it trying? There's a message over here. There it goes. Okay. Hit it too many times. If you hit Control plus or minus, you can zoom in and out. And then Control 0 puts it back in normal. Can y'all see that? Okay. Is that coming through? Okay. Just want to make sure it's visible and not too tiny. All right. So the NASDAQ is trading at what right now? Yeah, 60, 69, 60, 70, like right in between there, right? Just tear it off. Then I can really control it a lot better. And by the way, this little button right here lets you tear it off if you don't know, the little gray button. And what these are these are options on the NASDAQ 100. Okay? That's pretty much all they are. And they're vertical spreads, if you know what those means. If you don't, whatever. But they expire today. They're dailies. All right? So we have daily contracts that we're looking at. And let's see if kind of movement we've got on the NASDAQ. Opening up a Nadex chart. We'll see if their charts are working. They're always doing something to mess something up. And now and this is one of the most important points, and I think Sharpie knows this answer, but I trade futures and I trade spreads, both. And I trade them in live. I'm just showing you on demo right now, so I actually have another computer that I have trades on. So what we're looking at now is this NASDAQ 100 spreads. And one thing I want to tell you is NASDAQ 100 spreads, they used to tick at whole points, which was horrible. And I fought them on it, and after like 12 months I won. That went down to, they made a tick in 0.1 because everything on Nadex ticks in a single digit, a 1. It was 1 or 0.1 or 0.01 or 0.001. So even though the NASDAQ actually ticks in 0.25, okay, the NASDAQ spreads, use my own chart, NASDAQ spreads tick in 0.1. Yes, Nadex spreads on the screen right now, okay? Now, one thing I want you to notice about that is they changed the contract, okay? So understand this, they changed the contract on NASDAQ to 0.1, but they didn't change the width of the spreads, meaning the difference between the floor and the ceiling, okay? Like you can't lose any additional money below the floor. You can't make additional money above the ceiling. The most you could lose is 90. The most you could make is 310, on down the list, okay? That makes sense to everybody so far? All right. Now, proximity can seem huge here, but remember that it's actually, the way it's ticking is 0.1. What I want you to understand is NASDAQ, since the spreads are narrower on Nadex, because they didn't widen them when they changed the points, which go, well, hey, go fight them to have them widen them. Well, actually, I like it because then I can take advantage of what's called premium, okay? And I can go in and I can collect premium. So if you're a premium collector, you could go in and you could literally buy this contract for $80 and sell this contract for $80. Now, when I say 80, I mean you're collecting 80. So if I'm collecting 80 bucks on one side and 80 bucks on the other side, how much am I making? Like, what's my maximum profit? Let's just say if I get 80 on both sides. 160 bucks. Okay, cool. So, yeah, that's not a bad profit, right? $160. Now, if I can make 160, I actually get to take that 80 away from this side because I can't lose on both sides. Does that make sense? If I go short and I go long, like, and it just flies way up, well, the short will lose, but the long will make money. Okay? So if you have a flat market, it's not too advanced, and I'm helping you grab a concept, okay? But when we're going to get away from premium collection, I'm just starting here because so many people said NASDAQ, which makes doing what I'm going to talk about harder, okay? So if I can make 80 bucks on one side and I can make 80 bucks on the other side, then basically I can say I can make 160 here. So I can take 80 off that. I'm making let's just say 240, whatever. So I can make 160. I could lose $240, and that's if it stays in a 16-point range. Okay. So if it stays in that 16-point range, I will make money. If it goes outside of that range, then I'll start to lose money. Since NASDAQ is, and I want y'all to hear this, since NASDAQ is so close, the premium is higher. So don't judge all spreads by the NASDAQ spreads. Okay? Big mistake a lot of people make. Like, oh, the premium is so high, I don't want to trade it. Notice the premium is like nothing on the at-the-money spreads. So you can go in here and you can trade this contract, and notice the proximity is 0, which means it's a delta of 0, or 100, I mean. So it's going to move tick for tick pretty much with NASDAQ. So if we have flat markets and they're not moving, that is a way to make some money. Now, we said 16 points up and 16 points down. And after I get done with this example, I'm going to show you something that's really, really, really cool. But I want you to see, like, if you have a flat market, can you not make money when it's not moving? Yes, you can make money when it's not moving. That's $160. Now, it would have to expire in the center to get all 160. But 16 points up, 16 points down. So if we're at 60, 61, and I go to 60, 71, 60, 77, and then I subtract 16, 60, 46, whatever. So we got, like we're at 60, 70. So that's 16. I got to write this down. I'm going to forget it. Let's see, so 60, 70. And then, so we can go down to, if we got, we'll just say 60, you know, we're making it 160, it's a little bit more than that, but 16 points. So we can go up to 86. before we begin to lose money. We can go down to, let's take 16 points off that. We go down to 60, 10, 60, and then 6, 4, so 1656. Okay. Sorry, my math is a little slow today. All right, so understanding that, now let's go look at something else. And I know this is like, oh, but we're going to get to those of you who actually stayed on. So we still have a couple hundred people on. We're going to get to the wow moment in a moment. But so many people said NASDAQ, I have to help you on that. Because with the volatility being so high, then what I'm going to teach you is a little harder to do. Where I got 16 points from, I'll go back to in a second, but where I got them from was I can make $8, it said 80 bucks. So, and it's $10 a point on a NASDAQ spread because they tick in 0.1, every 0.1 is worth $1. So 10 dimes equals $10. So if my premium could be 80 bucks on one side and 80 bucks on this side, that's 160 bucks. Okay, so now I want to take you down here, and we had a range. And by the way, I'm not ignoring anybody's questions. I'm just sort of making sure I'm trying to stay on track. And we go up and we can see, what would it cost us to get additional coverage? And I can go, okay, what would I like my max? I can make 160 on this. What would I like my max risk to be? Well, if it's going to go up to 60.86 before I really start losing any money, and I only lose $10 a point, then I could actually go out of the money a little bit, and I could buy this contract at 60.88 for 25 bucks. That's going to give me an additional $75 of protection, okay, on one side. And that $75 is going to protect me by 75 points. So I can actually go up and add, 75 to this, go pretty up here, and I can buy like a $10 contract. I can do the exact same thing on the other side. 60.56 is where I'm going to start losing money. Okay? So I can go out here and I can sell this contract for a $25 risk, which would make me 70 bucks, and then drop that down 70 from 60.50 down to like, they don't even have one that I don't think. 50. There you go. Pretty low. $70. I mean, it's only, that's, we can go down here. We basically, I would get the closest cheap one I can get, so like 13 bucks. So I could take $60 of that 160, and essentially I can make myself have a insanely low risk trade, and I do absolutely nothing all day. I literally just put it on and leave it. Okay? So that is my favorite market to do premium collection on in flat markets is where what I do what's called an iron condor, which we have videos on that, okay, and where I hedge them with a spread. I would use no stop because what I'm doing is I'm buying these out of the money binaries really cheap with some of my premium I'm getting. I'm getting 160 bucks. So I'm going to go spend like 70 of that 160, okay? And so I'm going to buy these out of the money binaries. And so if the market does happen to fly, I have some protection to help take care of most of the risk. All right? Very simple strategy, but I would only do this if I have low, I mean, you can do it in high volatility markets too, but it's harder because the binaries, here's the trick in this. This is a whole, like, the thing that I hope you're grasping. Remember what I said, spreads on NASDAQ, specifically on NASDAQ, because of how they changed the point structure and they left the spreads the same, the premium is extremely high. But the binaries never changed. So get those out of the money binaries really cheap. So this is a way to trade NASDAQ in a flat market that's not going anywhere. And all you got to do is hop on a demo account, okay, and go over to the spreads. Premium equals, if it's negative premium, that's time you're paying for. It's like the insurance payment, okay, where you're paying a premium every month. If it's positive premium, then you're the insurance company. You're actually getting the money every month, okay? So if I add, let's just say this was 80 again, and that's 80. Add those together, that's 160 bucks, okay? And I go out and I go, wow, so I got a lot of premium. Okay, I'm covering over half the spread just by getting the positive premium spreads. And you can go, like I said, hop in demo, and you buy this contract, or you sell this contract right here. You buy, this is buy, sell, right? You buy this contract right here. You use little ticket options. In the scanner, it's free. And then go, okay, well, how high up am I protected? How low down am I protected? And then see if you can get like one option around 20, 25 bucks, one option around 10 to $15. And the earlier, like right now is a great time to put it on. So at 6 to about 7, things are a little weird. Stuff's opening up. Traders aren't really on yet. Like I usually give like about an hour, like 7 o'clock, until like stuff starts picking back up and traders are going again and IV pops, because the IV will actually, it's sort of weird. The IV will actually rise first before it drops. So I get 6 o'clock, I can actually be lower, and then it'll go higher for like 60 to 90 minutes, and then theta will kick in. Okay? All right, so the reason I had to teach this to you is so many of you trade NASDAQ, and if you trade what I'm going to teach you, it's not going to work real well because the premium is so high, you're not going to get the protection that I want to show you makes trading awesome. So I'm sorry. I know I probably lost a bunch of you on that. Hopefully I got some, interest in that. And so y'all can hop in and, Sharpie, you ought to start a thread. You got to ask Cameron to give you your own little thread, and you can like explain this all the time. Sharpie is the man. He has taken this and ran with it. Okay. But this is all web-based. It's on the website in Apex. It's under free tools. So here, I'll show you. Obviously, get the demo account in Nadex. Close. So used to my supercomputer. So if I go here to Apex, you've made $8 million. Sign up for a live account. Yeah, I have. Okay. Let's see. Everything just takes a little bit longer. But if you go to apexinvesting.net, once I get up to the house, it'll be a lot faster. Because I'll have my supercomputer. It's not my internet. My internet's doing just fine. But there's education that teaches you how to use it. It actually teaches you all the ins and outs of spreads, at least the basics. And then we got a bazillion webinars that I've done on them. About 7 to 8 o'clock is the best time to set it up. Yeah, because of that whole, it's weird. Like I said, the implied volatility, I don't know if it's market makers jacking with people or what it is, but it starts low and then comes up. So I think it's because they go in and they can basically lay those contracts off for people that top in early. But right here under Access Free Tools, you will see the scanners. And you just go in, activate it, access it, and then there's a course that teaches you about it. Okay? And then under Education, there's a whole thing on spreads. And by the way, what I'm about to teach you, the ultimate power play, okay? There's a course right there on it for you already. Now, when you log into Nadex, you need to really have Nadex in its own tab. When you log into the scanner, you need to have it in its own tab. What I mean by own tab is like I have 10 tabs up here. You really need to, and don't shrink it, just move it. Like tear it off, like click on it, hold it, rip it off, okay? And you can go on and it doesn't have to be on the top of your screen, but it needs to be by itself. Otherwise, Chrome like puts it to sleep and there's issues. Because it's live data flowing. So you don't want it putting it to sleep. It'll eat up processing power and memory and everything else. Let's see here. And yes, that was actually made in Nadex, so they won't increase your count above 25,000. All right, now let's get to the what I call the fun stuff, what I've been wanting to talk about. And I'm sorry it took me this long to get here, but I wanted y'all to understand what implied volatility was, what kind of market conditions you're looking for, and I wanted to help out all the NASDAQ traders who I knew if I taught you this immediately out of the gate would go directly to this and try to use it on NASDAQ. And since the implied volatility is higher because it's closer to the floor and ceiling, it doesn't work that well on NASDAQ. Works fine on ES, TF, YM, okay, but not on NASDAQ. Let's see here. I tore it off. There it is. All right, so now that we got that, and to help you understand one more piece, okay, of the whole, why not ES, or why not NQ, I mean. And this isn't really that horrible. It's just, what would y'all say your average point stop is when you're trading on NASDAQ? How many points? Not ticks, but like $1 increments. So 5, 3. Oh, when you say 20, you mean like 2. There's a couple of 20s and 25s. So one person said based on account size, and I would actually challenge you on that. I would never base my stop on my account size. The stop should always be based on the chart. And then your account size and the risk percentage determines how many contracts you can trade. Because, and I don't mean this to sound bad, but the market doesn't care how small your account is. So you shouldn't make a decision based on the size of your account, in the sense of where you're going to put a stop or an entry or take profit or whatever. If the risk is too big based on your account size, you either pass on the trade or you find a different instrument where you can trade it for a lower value per point. So if you're trading NASDAQ, you're trading at $20 a point, okay? Because it has 4 ticks, and each tick is basically a quarter in a point, and every quarter is worth $5. So you're risking $20. Well, if you go over to NQ you trade US Tech 100 spreads, like these at the money ones right here, that will just mirror the market, then it ticks in 0.1 at a value of $1. So now you're risking $10 per point. So if you're moving stops based on your account size, you need to really rethink that and look at the chart. Let the chart tell you what to do. And if it's too big for your account size, you need to find a smaller instrument that has a smaller tick size. Now, it may be moving over to US Tech. It may be going from oil to, you got mini oil here at $1 a tick. So you may have to go to a different market, or you may have to go to a different instrument like a near the market, which is basically where the proximity, it's like right at, like 60.71, and the market's priced at 60.70, 67.3, market's at 60.72. Got it, didn't sound bad to you, good. So yeah, basically we're talking about 5 points. So here's what I want you to look at, and this is sort of a cool way to do this. Let's say I buy this contract right here, okay? And we'll say I sell this contract right here. What I want you to notice is, okay, now to explain this graph to people who haven't seen it before, this is the price of the NASDAQ, okay, at the bottom. Goes down, goes up. This line is where the NASDAQ is currently trading, okay? This up and down vertical black line. This over here is profit and loss. Okay? Now it's not combining them together yet. That's a future feature. But just understand that's P&L. So like this is maximum loss on this spread. This is maximum loss on, maximum whatever on this spread. But what I want you to notice is the maximum profit on this short spread covers the maximum loss on this spread. Do you see that? All the money that can be lost here can be made here. It can, is that clicking with everybody? Yes, yes, Yippee doodles, not really. No, yes, okay, good. I'm glad y'all are. So, okay, so if I buy the spread, here's how spreads work. Okay, they all tick in, like I said, at like a 1 or a 0.1 or whatever. This one ticks in 0.1. If you ever want to know, we have this little link right here, you can open it up, and it will tell you like what it ticks in, what hours it trades, things like that, okay? It also tells you what the underlying future symbol that it's following is. So NQ is E7 or 1217 like in Ninja. So that's for, TOS traders. You can buy and sell on the same underlying market at the same time, which is accurate, David. But you're not buying the same contract because remember, this is an option. It's not, you're not trading NQ futures. Okay? That's just like the information thing. So you're trading an option. So when I buy this contract, my risk is defined up front. See where it says like 0.1, 0.25, tick value 1.5. It'll tell you it takes 2 Nadex spreads to equal 1 NASDAQ future. Okay, very important for if you're going to hedge a future. Okay. And this expires at 4:15 today. They're all daily spreads, which is amazing because that means they're really cheap. It's actually cheaper to buy 5 daily spreads than it is to buy 1 weekly spread, and they move faster. And you get more premium. I mean, like in every way, it's better than using even weekly spreads or weekly options. So if I go in this contract right here and I buy, the market's here, okay? And this thing's like right on the market. Like I'm buying it at the market. Market's at 60.71. I'm buying at 60.71.6. I mean, it's, less than a tick off. And then if I go short this contract, okay, here's the profit I can make, and here's the maximum loss. It's just like a vanilla call or vanilla put on Apple or whatever. I'm not talking about where people call binaries calls of puts because that's wrong. They aren't. But very, very simple. Just makes money, has a cap. If you're selling it, the cap is the bottom, the floor. So we sold this contract, so the floor there is 60.30. So it'll make money down to 60.30. If it goes past 60.30, it'll just be at max profit. Okay, it's not like you stop, you lose or something. So if it's not a bad thing. So I can go in, and now what I want you to do is I want you to do a math lesson thing for me here, okay? If I buy at 60.72 and I sell at 60.62, like let's just say you did a trade. Like forget the spreads, forget the options, close your eyes for a second, okay? If I enter a market at 60.72 and I exit at 60.62, how much do I lose? 10, right? At least 10 points, okay? So all I got to know what is my max risk on this trade is the difference between the contract I buy, whether that be a future, okay? You could just trade NASDAQ futures. You could buy them, and you can sell these, okay? You need to make sure you do 2, so that way it equals $20, a tick. And if it gets way below that level, of course, you want to get out before it gets below the level because it will only hedge you down to 60.30. So loss of 10 points. Now every point is worth how much on Nadex? What's a $1 move worth on NASDAQ? So a $1 move would include 10 dimes. Yeah, so $10. That's right. So $10 per point. You have 10 points of risk, 60.72, 60.62. So what is your max dollar risk? If you bought that contract and sold that contract, what's the most you could lose? $100. Okay. Now, I don't know about you. I'm not really a big fan of you and losing that, that much, but that's your worst case scenario. If you just thought the market was going to go up today, you could put that trade on and go to bed. And the worst thing that would happen would be you lose $100. Okay. Everybody got me on that? And then another trick is how far does it have to move before you make money? Okay. So in this case, it's reverse. This is a little trick right here. Is proximity. So 40 means 4 points. Okay. So once it moves 4 points, you'll be profitable. Okay. So pretty cool little trick that you can use. But if everybody gets that, that's $10. It's not great, but it's not horrible. And you don't have to get all caught up in, well, this contract over here, says that I can lose $427. Well, yeah, but this contract over here says that you can make $325. So 325 and 428, bid offer spread right there. We're not being exact with the ticks, but $100. We're actually seeing this can make 325. This can make 425. Obviously, if it maxed out, I would lose $100. And then of course we go the other direction. This can make 376. This can only lose 77, so I can make $300 on $100 risk. Now that's with a big move in the market. Okay. So my biggest point here right now is I would much rather notice how the spring down to $70. Look at the other one. What was it at? 74. So if you would have went in and got those at 80 at 160, okay, you'd already be up 12. So you'd already be up $20 for the day right now. Whenever I said they were 80, actually they were like 82 and 83. So you'd be up about $25 right now if you would have got those contracts back when I was going over with you, just on time. Okay. So again, I much prefer the premium collection strategy on NASDAQ, and you have a little bit of an edge because the premium is higher, even with IV being low, but your binaries are still low. 7 to 8 p.m., not a.m. I usually hold my premium collection contracts to expiration. The only time I don't is when they're very close to maximum profit, or you can play deviations and stuff, but when they're closer to maximum profit, I'll close it out, because a lot of times the market may reverse and go back the other way, and I can make profit on both sides. So I just need to make sure my risk is covered on the other side before I close out one side. Now, let's look at something else that I think you'll be impressed by. And I haven't even looked at this yet. Okay? So let's look at the S&P. We'll look at this little low. Let's see which one. We'll look at this lower risk one. Okay? Right there. And then let's sell this. Now, let's do some more math. If you bought at 25, and I'm just trying to keep the numbers simple, 25.48, and you sold at 25.46, what would you lose? Yeah, 2 points. So if I put this contract on and the market let's say I'm long, okay? And the market stays flat, doesn't move up enough to, get things going over here, because I basically got to make enough on this to cover the risk. I got to pass this, max loss here. So it doesn't move up enough for me to, pay for my premium. And it just goes against me and floats down here. They both expire at 4:15. See, this doesn't happen unless you have low implied volatility. Okay, and again, don't do this on NQ, like I just showed you, like it's 10 points. What is my risk on this trade? 20 bucks. Now, let's do some math to convert it for futures traders, okay? It ticks in 0.1 on Nadex. It's a North American Derivative Exchange. It's in Chicago. It's regulated by the CFTC. Your money's separated, and it's easy to withdraw, okay? I withdraw weekly. So what is the value of the ES? Now, again, you can always cheat and use this little paperclip over here. But what is the value of ES per point, the actual future contract? So 1250 a tick, and how much a point? So like 1250 is a tick, it ticks in quarters. There's 4 quarters, right? So 1250 times 4 equals $50 a point. What's the value of a point on, we'll call them US 500, the Nadex spreads? $10, right? Because they all move in, like in this case, 0.1. Okay, and you can know what they move in just by looking at the quote. So it says 0.8, 0.0. If it had like nothing on there, like Dow, then it move in whole points, or oil 0.01, or natural gas 0.001, or some FX pairs 0.001. So all you gotta do is look at the quote, and that's what it ticks at. It doesn't. You don't have to use the little charts and everything, but. So if it ticks at $10 a point, okay, how many, if I'm a futures trader, how many Nadex spreads do I need to cover a futures contract, a hedge? You probably heard the term hedge before. This is actually what it means. It means to lower your risk. You need 5. Very good. Does everybody get how I got the number 5 and how, what do y'all get 5? You just put 5, 5, 5, 5, 5, 5. Okay, good. And if you don't get what I'm saying, you have to tell me, or else I'm just going to keep flying. Okay. So if we go right here, every Nadex spread ticks in 0.1. Does that make sense? Joshua, Lau, y'all got that? Like every, or it ticks in a 1, I'm sorry. It always ticks in a single digit, 1.1.01. Wow, does that make, you got it? Okay, cool. So if it ticks in 0.1, that's a dime. Is the way to, easiest way to look at it, okay? Like 10 cents. You got 10 dimes and a dollar, right? So if you have 10 dimes and a dollar, and every dime in this case is worth a buck, so you got 10 ticks, tick being a pip or a cent, like in stock, okay? This means minimum increment move. So it can move in price 10 times before it goes from 2050 to 2051, okay? We go 2050.1, 2050.2, 2050.3, okay? So there's 10 ticks, 10 dimes, and a point. Every tick is worth $1. So therefore, a 1 point move is worth $10 because you got 10 ticks of movement. Okay? So if every point is worth 10 bucks on the spread, on this spread, okay? And every point of movement on ES is worth $50 because ES ticks in quarters, and it's worth $12.50 a quarter. Okay, like every tick is worth $12.50. Makes futures so much harder to learn. But ES ticks at 12. Like every time it moves it moves a quarter at a time instead of 0.1 like on Nadex. Every time it moves a quarter, then the price changes by $12.50. So you got 4 quarters in a dollar, 4 ticks in a dollar on the future. Every tick being worth $12.50, 4 times $12.50 is $50. So on ES, a 1 point move is 50. On Nadex, a 1 point move is 10. So if I go long ES futures, and I want to hedge, like let's just say this was the ES future instead of a long spread, and I want to hedge my ES future, okay? Then I need 5 because it's only worth 10 bucks a point, and I need to cover $50 a point. So that's why I would get 5. If it's on oil, you know, it's worth $10 a point, so oil's worth $100 a point, so I get 10 in oil. So, but all those numbers literally are right in here. You just click it, and it says the ratio. Okay? All right. Yeah, Iron Condor, come back to that. That was more for my, like, I got to trade NASDAQ premium collection traders. This is the one that I love. Okay, premium collection is fun, but this is what I love. Okay? Now let's look at it again. Our risk is basically 2 points. Anybody here trade ES? I mean, most of y'all said your average stop was like 5 points. Some said 2. Okay, we got some ES traders. Is a maximum 2-point risk a pretty nice risk? And what about a 2-point risk? That's sort of cool, all right? With a $217, or you can even do a $417 prop potential, depending on which one you want to use. Okay? Like let's say the $39 loss, so 80 bucks. Potential. Has to move really far, okay? To make all that. But it doesn't have to move far to make money. It's not an all or nothing. This is nothing like binaries. I honestly think every new trader should stay away from binaries. Period. Like, I don't care what your excuse or reason is. Whatever you think is the reason you should trade them, I can tell you why you should. Make more money. Tell me a binary where you can risk 20 bucks and make 400. So I got Matt. I'm glad you brought it up. I don't understand. He says, I don't understand how your risk is only 2 points. Okay, if I buy this contract at 25.48, okay? All right, my max risk on that is $183. Okay, that's buying basically, that's doing the math of 25.48.3 minus 25.30 is 183 ticks. Every tick's worth $1. Okay, so I have $183 risk on this contract, maximum if I held it and it went all the way against me. Okay, and then I go over here and I sell this contract so I can make money if it goes short. Okay, if it goes down, I make money. I sell it first, buy it second. So I sell it at 25.46. I'm just not using decimals to make life easy. So what's interesting on this one is I can make $360, $350 or whatever. Now I'd have to take my max loss 183, so pretty much 180 bucks I could make after this lost. So if this contract lost all $183, the short contract would be making all $183. Okay? And then it would, if it kept going, it would continue to make money. So I actually can make money if the market goes up a little bit or if it goes down a lot. But since I have this hedge, this short contract's risk is fully covered, even if I went with this one that goes further down, okay? Right there. The maximum loss on this long contract is covered by the maximum profit on this sold contract. Light bulb moment. There you go. Sweet. I love those. So my risk literally is 2 points. And it's only got to move a few for me to cover, the premium on that to get past that 2 points. Okay? Just got to move past, see this little area right here, this little red dot? Price got to get above that red dot. So that way this contract can make what this contract loses before I start making my money. Now, I can go in here. Yeah, you can go in, by the way. Yeah, somebody's asking a more complex question, but yeah, you can cover the entire market for like 40 bucks in either direction. So it's pretty cool. But the big thing I want you to see, now if you're a futures trader, hop on. Like, there is no reason why you shouldn't be doing this. Okay, think about this. You go in, your max risk is 2 points. You can hop in ES. Let's say you get a long trade on a power play, power plays or IZSS or whatever system it is, C's, whatever system you use, you put this hedge on, and I mean, especially because if you've learned to trade the power play system, you've also learned how to identify chop, right? Like that's a big thing we teach you is how to identify chop. So why not, when you're at the bottom of that chop zone, you don't have a signal yet, right? But you know you're in your little chop box. You're drawing your chop boxes, okay? Especially if you're in the mentor groups. Better be drawing the chop boxes, right? Why not buy this cheap little spread right here and go in, or like I say that we'll say sell this little spread right here, 37 bucks, okay? And then go buy a spread or or sell 5 of them, go buy a future. And when it comes up, to within like maybe a point or two before the chop box is over, take profit. Okay? And when it's up there, you go in and you sell the upper spread. But now you go short. Like maybe you sell 5, you go short ES, or you sell 1 and go short, that one of the middle spreads there. And it goes down lower to the chop boxes that you've learned. And so you go in and you're taking, your first profit will probably cover the risk on this contract, okay? But let's say it bounces up or down 4, 5, 6, 8, 10 times. Your second one is money. Like it goes back down, you sell, or you buy back ES, and then you buy the sold contract, and now you buy it and go long, and it goes up for a few points. If it goes down, it goes down for a few points. You literally have, and this is actually called reverse gamma scalping. If you want to get real particular, but we're not going to, you don't need to make it hard, okay? Learn how to draw chop boxes. And so in these chops where you're like, ugh, and then when it does break out, you're like, yeah, it moved a whole 3 points, thanks, right? Okay? You can go in and, like I said, when it's the bottom chop box, you put that one on, top chop box, you put the other one on. And again, it'll take you like a trade to cover the risk on the spread. Okay? Like if it goes up. And then goes up, then you do a short one. First one takes care of the premium. You paid your premium out, okay, and now you're just hedged for free in that whole chop zone. Okay, so now you're playing it back and forth, and then you get a signal, like a signal to go long. Well, now you've already hedged all your risk. You've paid for the insurance. It's paid for. It's free now. Go have a wreck. It doesn't matter. It's not going to cost you anything because you've already taken care of the 2 points. You've taken care of the 37 points. And you can hop in and you take that signal. And, you got to stop all the way down to 25.10. You got 40-point stop loss. And it started out with a risk of 20 bucks. And normally, you have to do this on 2-hour contracts. Okay? Because the premium's so high. But right now, with implied volatility being so low, you can actually do this on daily contracts, even at night. So you can go in. How would I apply this at night? Well, you definitely got chop at night. Do you agree? Everybody agree we got some choppy crap at night going on? Yeah. So go in and get this cheap little contract short, near the bottom of a chop box, okay? And it doesn't honestly even have to be at the bottom. It's just, it makes it cheaper if it's closer to the floor ceiling, okay? And then go in, and when you think it's going to pop up based on anything, and I'm not talking about a signal, I'm just talking about your board, you have nothing to do, okay? You're waiting on a signal. And the signals aren't even that big because the market's only moving 4, 5, 6 points, and you got in 3 points of it. So you got 3 more points if the market moved and you're frustrated. Put this thing on and go in and just play that chop back and forth, because now you should be a chop master if you're trading the power play system. And this really isn't about trying to go. Now can you go in and just go for it? The other night I went in. It didn't happen, unfortunately, but I went in and I bought, like, had $40 risk. Like, um, tonight's even better, only 20. And I went in and I went long a cheap contract. I got one of these up here, and I went short the expensive contract before the Fed funds rate. Like, I put it on at night. Okay, and I'm like, hey, if they piss everybody off, I'm risking, $40 a contract, and I could make, around almost 400. So, pretty close to 10 to 1, maybe 8 or 9 to 1 ratio. And that's a trade I don't have to manage. I just let, like, the market explode. If it doesn't, I'm out $40. I don't have to watch the market all day long. Okay? So if you just want to play a directional play, you can. Now, that was just me going, hey, eventually the Fed is going to upset everybody. So if I can get low IV and I can put on a trade I don't have to think about, that's, like, to me, the way to do it. But this low volatility lets you get these cheap contracts. And that's ES. We can go over, we can look at the Russell. I mean, if you're not trading this way, you are missing out, because trading is boring. Okay, think about this. You put it on, whatever system you're trading. Like, if your risk is $20 or 2 points, and you can't get stopped out, remember, because you got a full hedge on. If you can't get stopped out of a trade and your risk is only like 2 points, are you stressed out at all when the market takes against you? Like, would any of you be stressed if you had a 2 point stop and you can't be stopped out? And I'm not talking about just buying the little, out of the money spread. No stress. What's funny is you're sitting there going, move, come on, move. Like, that's what you're doing. You're not going, oh crap, what happens if it goes and hits my stop? What am I going to do? Am I going to get out? Am I going to follow my rules? Is the lawyer going to yell at me? All that, okay? And so I can go over here, and now, like, my stress is gone. But we're still using our skills. We're not just throwing on a random trade. That one was just like a random trade, but it wasn't totally random. It's based on one of these Fed funds. They're going to say, hey, we're going to raise interest rates. And they're like, oh, the housing market will go crash, whatever. So I just play the play until, I can be wrong like 8 times. And if one of them works, then I make, money, or at least break even. But normal trading, like trading that I love to do, I go and I do this. And what I love to do is go in and when it's low on all the other markets besides NQ where you do that premium collection thing, and don't go to that one first. It's complex, okay? Go in here, and, let's look at this. Okay, Russell. I have traded Russell. That was the instrument I fell in love with that I had to eventually let go. And I go in on this Russell contract, and then the question is this max risk, your actual risk? No, it's the amount of money you have to put up. Like, I could get out if it goes $1 against me, right? So right here, the Russell, okay, could be a scary thing to trade. We can even look at it. Let's see here. That's interesting, but not good. Let's see here. We need one that makes some money. There we go. All right. 1507.6 minus 1505.2. Okay, so that is 2.3. That's $23 risk. 24. Thank you. Like $24, like 2.4 points risk on Russell? Are you kidding me? Like, that's freaking awesome. Okay? I never traded. When I traded futures, I never had a 2 or 3 point stop loss on Russell. You were asking to get kicked out. Okay, so the first thing I want you to understand is the risk is covering the risk of the spread. Now, if I do go long like the futures and go, short the spread, I do got to be aware of the floor, and I have to have the money for the drawdown, right? Because, yeah, okay, well, it will cover me all the way down, and it will make $252 times, I guess, 5 now. So it'll make $1,000 on the way down, but I got to be able to lose $1,000 in my futures account, make $1,000 in my Nadex account, and then may have to move money back and forth, or I could just use a spread and make it easier. So up to you. Either way, it doesn't matter. The nice thing about if you are a futures trader is you're gonna get a little bit tighter bid offers when you're trading the futures, and so it makes it easier to scalp, right, for a couple points. Like you can really get that couple points even faster. All right. Let's see here. Let me go through a few questions here. Let's see. We got YM Premium. Let me pull that one up. And again, you just look at this and you go, okay, I can go in, I could buy this contract, and I can sell this contract, and my risk on the trade is 27.92 minus 63, so 27, no, 7, 8, 9, 29 points, right? So $29 risk, that's really not horrible on the Dow. And you go into, again, to scalp, and it's 5 to 1. Don't be afraid to look at other markets. I know you've been trained to look at one market. I highly suggest, now don't look at like all the indices. Like you can look at all the indices if you want to use them for analyzation, but like trade one or two of them only. I like to have a metal, an energy, an FX pair, and an indice, and an interest rate if you're going to trade that level. But be careful on the interest rates. You got to really learn them. That's like level 4 trading. Okay. But I like to have like one of each because something is usually moving. All right. Or something is chopping. And I can take advantage of both. So in the chop, one of the questions was, so how do I use this in chop again? So let's say you get in this contract. And I mean, it's only a 2-point, literally 2-point bid offer spread. Not a big deal, okay? And let's say you have a box that's, we'll just say 15, 20 points on the Dow. Take some whole numbers. So it comes down to like within a few points of the bottom of what you defined as your chop box. You go in and you sell this spread, you buy this spread. Okay, you sell this low risk spread, and you roll with the lowest risk you can get with the closest difference between the sold price and the bought price. Okay, so lowest risk you can get with the closest difference between the bought price and the sold price of the two contracts. You go in, market moves up, and let's say it moves up 20 points. Okay, grab your profit. And then you may go in and you may sell the other side. So you sell the low risk spread over there. You bought that one back. Now you have a hedge if it goes up, hedge if it goes down. But how do you make some money like with the fast moving spread? Because if the proximity is high, it's not going to move real fast. So now I can go over here and I can sell this contract. And I'm hedged. So it goes down 20 points on the box. And just literally rinse and repeat as it goes up and down between the box. So you buy the spread for the cheap spread, the one that didn't. This isn't really a cost, okay? It's a max risk. If it was a cost, your money would be gone when you entered. A cost is commission, okay? Like the exchange fee of $1 or whatever it is. That's a cost. $38 is not a cost. $38 is a max risk that you're putting up. So you may not lose any of it. You may make money on it, okay? Like you may go in and go long on this one, get out, and the market might drop 10 points because of some news announcement, and you end up like cleaning up on that short little cheap trade, okay? But that's how I would enter and exit on chop. I literally just go in and hedge one side, go long, take a profit, okay, go short, take a profit. And now when you do this again, it may take 1 or 2 trades to cover the premium, the risk in that spread. So but at that point, then you're just going in and hopping in, hopping out, hopping in, hopping out. And if it goes against you, you're hedged. So once you've made that $20, you hop back in when it goes back down. Well, you've already made the $20, covered the risk of the spreads. So now you're just, I want to be make sure I'm compliant, but you're basically doing a trade. It's not risk free because you're always risking capital, but with a non-additional risk trade, because you had a risk when you started, and you could be risking capital you're putting in, but since that capital is fully hedged, you're not adding any additional risk by like going in and buying at that same price that you originally bought. So like if it goes 27.91, and let's say it goes up to 28.10, and you sell it, and it comes back down to 27.91, and you buy it again. Okay, well, great. Now you've locked in now $20 profit. That was your original risk on the trade. You covered your risk on the trade. If it goes down, well then you won't make anything, but you won't lose anything because you've covered your risk beyond that original $20 that you put up. Goes back up, make $20, drops back down, get in again. Goes back up, drops back down, get in again. And you're just literally going in and taking that money in between there, but you're doing it without having to freak out about it going outside the chop box. Because again, it's not going to get worse than $20 or whatever the risk is on the trade. So if it's not going to get worse, I'm not freaking out. I'm just sort of like going, please move like within a couple points. I don't wait till the top of the chop box. Usually I'm getting out a couple points before. So I need to sort of look, because like you have your highs and your lows, and you have like your most bars are hitting that price. So I'll try to hop out like right before that, because that's where everybody else is hopping out to. And so I want to get right before them. And literally just rinse, repeat, rinse, repeat, rinse, repeat. And then you get a power play signal. Go long, or a power play signal like an X or an E or whatever. Well, sweet, because not only have you actually made some money while you've been sitting here being bored, but now you can put the trade on, and oh, by the way, it's hedged already because you didn't pay more. You left that hedge on it. You have it all day till like 4:15. So it's power play or IZSS or C's or whatever crazy strategy you do blows up, you're hedged, and your stress is like whatever. I mean, it literally doesn't get better. So, Jeff, does that make sense on the chop box? Like, basically, I just wait till it goes down the bottom of the chop box. I get the cheap spread that I sell, and then I go long. Get to the top of the chop box. I buy the cheap spread, and I go short, and I just keep, like I said, it'll take a couple trades to cover the max risk on the spreads. But like when you enter the trade, you only have like a $20 risk. I do like them to be overlapping if I can. They're not always overlapping. The question is, you pick your contracts by lowest risk, and they have to be overlapping contracts. If they're overlapping, then that means just like immediately my hedge is in effect and my max risk is there. The downside to overlapping is it has to get outside that line before I really start making money. Okay? So my max risk has to get like 2 points outside that before I really start grabbing cash. The upside of it be like if the market was on the other side. Let's see here if it is, if I knock these out. So like here it's a little bit further out. And my risk on this trade, 27.90, 28.28. So I have a higher risk. See that? So I have like a $38 risk. But I'll immediately start making money because I'm already below that low right there. So, but the idea is the lowest risk spread, which you're only going to have two, like for the longer term contracts. And you can choose which one you want here. I mean, if you're going for big moves, like if you get a power play signal, I'd probably use the bigger contract if you have the funds. Again, you're hedged, okay? So like, don't freak out. I get this long contract hedges that short contract all the way down because these are dailies. Or if you're in futures, just make sure you manage your funds properly. All right, first this is right. Okay, is this right? First, you expect the market to go up. Right, because you have like you're hitting the bottom of, say, a chop box. Then you sell I'm going to fill in a word, cheap spread, has a ceiling near the bottom of the chop box, has a ceiling near yeah, exactly. And you just leave it alone. That's exactly right. Then you buy or sell one of the ATMs, I call them NTMs, so near the market, because I used to use ATM a lot, probably have some courses out there, but really at the money would be like at the floor or ceiling, so I changed it to near the market. So I'll use MTM over here. So near the market spread. Then you buy or sell one of the near market spreads, the price moves up. Yep, and then you take profit, okay? And then, if you believe you got a chop box there, you can also go in and then at that near that top of that chop box, you can then buy a cheap spread where the floor is near the top of the chop box, and then you can sell. And it goes down. You just play ping pong. Like you probably heard about where we're playing ping pong. Well, this is how you can play ping pong for really low risk. Just go back and forth, back and forth, back and forth, back and forth, and then if the market explodes, you already have a contract on. So on this contract chip, what I'm talking about right here, I'm scalping between the chops. I'm not trailing. If I trail, I'm going to give up a lot of my profit. Like I'm going to go like a few points before the top of that chop box because we teach how to do chop boxes in the power play system. So it's right when you hit like an ice level, implied volatility based deviation levels that sounds weird, but I invented. And then it's in the book, The Global Macro Hedge. And then we also have I zones, things like that. And then we have magnet levels and stuff we teach with order prints. So, but when you get those chop boxes, then I'm just playing ping pong between the bottom and the top of the chop box. I'm not trying to go with it. Now, if I get a signal to go, now I'm going to use the trailing chops like we teach in the system. So, Elvis, you say use standard deviations as part of your strategy. Okay, I'm going to challenge you on something, okay? And we give this away for free. The implied volatility deviation levels are free. Standard deviation is based on what the market has done. Okay? It's a historical average calculation. And think about every risk disclaimer you read. Past performance is not indicative of future performance, right? So standard deviation, like I remember Ben Bernanke saying, yeah, the whole model is broken. The deviation model is broken because it was all historical. Implied deviation levels, which again, we give away for free, okay? They auto plot on 22,000 markets. If they don't plot on one, let us know. We'll fix it. Are so much better than standard deviation because it's the market telling you what the market's going to do based on the price of the options. So we automatically extract the price of the options, and we let the market tell you based on implied volatility how far the market's going to move. So it's forward thinking based on people putting their money where their mouth is, based on what the market has done. So if you're already using standard deviation, that's awesome. I'm going to challenge you to go to another level and use implied deviations, and they'll be close, but I mean, as well as I do, 1 or 2 points on close can mean all the difference in the world of you entering, exiting, missing an entry, getting stopped out, etc. These things are insanely spot on. If you just chart them, you'll be like, holy crap, okay? And they change as implied volatility changes, like drastically. Can you do this on 2-hour spreads during the day? You can. There's nothing wrong with doing it. You can even do it at night on the FX spreads, okay? Just one of the points I'm trying to make to you is these things last all day, right? And they're cheap. So 2-hour spreads would probably be what you would need for like pulling off a NASDAQ trade, okay? Because of the volatility issue. But for like the other markets, they're so cheap you can do them on a daily, and you don't have to keep putting that premium back up again and again and again. Like, and you have all day till 4:15. And like, so you go long, you take your trade, that little, $30 or whatever you put up on that short spread, well, you made, let's say 100, it moved 10 points. So let's say if you had a total loss of $36, you're up $64, okay? You do nothing. If the market drops back down by the end of the day, you can actually make money on the other side. So that's why this is a golden opportunity. These things are cheap. And when I say these, I mean not only spreads, I mean daily spreads are cheap, okay? I see how sold is low risk, but buy at 387. How is that low risk? Okay. Remember, that's maximum risk if you have no hedge. Okay? So if I go in And so the table was like, okay, see, $36, yeah, that's low risk, but this thing has $394. All right. Look at the profit on the sold contract. See how it makes money as the profit on the bought contract loses the money. So even though this one may lose $394, this one can make $364. Okay? Which is 30 points. And by the way, it's 27.93 minus 27.63 is 30. Notice that? Like 27.93 minus 27.63 is 30. And if I can make 393 and lose 363, that's 30. Okay, that's where we get our max risk. That's the worst case scenario. So the reason it's not low risk. Now, I mean, you can get out when it falls 2 points, and you don't have to lose all 393. You know, you can get out just like any other contract. Just like you're not going to necessarily make 407 because that's a max profit. You're usually going to get out before then. But unless it's just a really good day. I love those days. But you know, we're not having them lately, right? We're in the small moves. So by combining the two, the profit on the sold spread is covering the big risk on the bought spread. And so now your only risk is the difference between the two, 30 points, $30 in this case. And as soon as it gets above here, you make a few points, you're in pure profit zone. But you have zero fear. The thing can go against you. Okay, it's like having a 3-point stop loss. All right? If it's at like 793 and it can go down to 400, that's a 3-point stop loss for 393 points. You're literally getting it can drop 393 points against you. It can drop all the way down to 2,400. And the most you're going to lose is 30. So you're getting a 390-point stop loss. And by the way, you can stay in the trade because the loss can't go up. And if the market reverses by the end of the day, you can still profit. Unless you're a future trader, then you need to hop out of the trade. Like, admit you're wrong and look up for the next setup. And sometimes, you know, if you don't do this at night, you're going to have to use 2-hour contracts because the market's going to move. And they're not going to be near force or ceilings. Okay? But it's so cheap. Like, it's a $30 risk. You risk $30 on like any Dow trade you do. Okay? 3 points. Now do it with like a 390-point stop. Like, there's zero fear. You know how much more clear your mind is when you're not worried about every tick against you? You're able to sit back and read the market. And guess what else you're able to do? And this is huge. We talked about it. You're able to look at other markets because you're not afraid of this contract going against you. You're waiting for it to move far enough so you can start trailing your stop in its favor. If you're doing a longer contract, or you're just setting your take profit and looking for the next thing. So you can have like 4 charts. Okay, here's a NASDAQ one. Okay, we got chop. Oh, look, good gold. Okay, we got chop. Oh, look at oil. Oh, there's chop. You know, take advantage of it. And then you just put your take profits on and then set little, you know, price alerts on your screen, and boom, they pop up. Redo them. There's not yet a market replay for Nadex. It is on my wish list. It's been on there for about 3 years. We've spent, I don't know, like I don't know how much. I don't want to know how much. Hundreds of thousands of dollars that we spent on building the scanner, but we're actually making a whole new version coming out next month with the new back end so we can do things even faster. And one of the things I want to do is actually record all the data and make it where you can do a market replay. So it is on the wish list. I want it because I think it'll help expedite traders learning Nadex a lot faster, and you know, for testing strategies and stuff, and even for automating back testing. And so that's in the works, but it's been in the works for a while. We will get it done. It's one thing at a time. Let's see. In the strategy, I'd be using an in-the-money spread based on my directional bias and an at-the-money spread as my hedge. You got it. Yep. But you really have to know where your floor and ceiling is. I mean, no, just look at the floor and ceiling here. Like, it's not, you know, you don't freak out about it. Just learn to draw your chops. Now, you can also do this on any signal you get. Any single signal you get to go long or short. We're not doing premium collection unless you're doing that iron condor NASDAQ thing I showed at the beginning. This is like going into scalp trades or to hedge trades. With that ultimate hedge strategy shows you how to hedge them, but I'm showing you how to go in and scalp. Okay, sounds like I need a head to video library and board with your jargon. Yeah, so you'll want to look at the Nadex spread course. You want to look at the Ultimate Hedge course. Okay, well, this has nothing to do with the chop box. This is a P&L graph. Price goes up, you got profit on a long contract. Price goes down, and this is price of the NASDAQ, you got profit. And then here's profit and loss in dollars on the left side. Okay? So chop box is what we teach. If you don't know what a chop box is, that's what we teach in the PowerPoint course. You can take it for free on our website. Let's see here. I mean, on a signal, could you set a hedge and once it passes the risk, would you trail or just stick with the standard trailing? On a standard trade, okay, then yes, I love to hedge because now all my fear is removed from the trade. I'm like, okay, I can lose $30 or 300 or 3,000 or whatever your account size allows. Like I've accepted the risk. Like I immediately accepted the risk when I went into the trade, and I know it won't get any worse. And now I just sit back and wait for it to move enough to be worth trailing, and then I start trailing it. And then, hey, maybe I get a free trade when it goes the other way. Daily deviation levels are also under the free tools section in apexinvesting.com. Do I provide value area parameters? That we have an advanced version called ICE. It's a lot more accurate than your standard value area. We actually look at every volume on every tick, and we plot it based on the actual close of that market, not just a standard one like most of them use. And it's called ICE, and it's just basically an improved, a highly improved value area. So we do have it, yes. So here we go. Like if this is a chop box, I'm just trying to give you an example, okay? My ticks are probably too big, but this was a chop box right here. And let's back up so we get the night. So they had a nice run. They had a nice, people's like, oh, there's no movement. There's bound in for you, 80 pips. All right, so right here, the market starts chopping. Okay, so you don't know that, boom, and then all of a sudden you're not making higher highs or higher lows. That's how we teach you about like it's chopping. And we also are at a settlement level. We have the upper ICE, or actually we have the point of value part, that you're talking about on value area, that blue line right there. So the market's literally like just hopping around between settlement and point of control. So does that. Okay, we didn't make a higher high. We came down. We didn't make a lower low. We didn't make a higher high. Okay, at this point, I think I have chop. So I'm going to go ahead and I'm going to buy a spread and I'm going to sell. Comes down. I take profit on that one. I think it's going to go, again, I said before, a couple points before the bottom. So I go ahead and I buy a spread. It comes down. I take profit right as it hits that low, just barely hits it. And then, so I buy a cheap spread. And again, you might have to do this on 2 hours, depending upon where the spread contracts are. That's why the scanner is nice, because it shows you all the contracts at once versus just having to click between 1,000 things on the Nadex platform. Then I go long and it goes up and it passes. This is my other one. And I go short, but I'm hedged, right? Like, so I go up here, I take profit on this long one, that near the market contract. So now I got a short, or I got a long up here, and I got a short, down here, okay? And then but when it comes down, I buy, then I sell, take a profit on that. It keeps going, and I'm assuming no signals at this point. I'm just acting like there's no signals on the chart. Goes up, goes up, goes up, comes on back down, and I can take a profit. I start to come back down there, so I can actually enter another trade to go short. Because remember, I went short here, right? It went up, it went against me, but I was hedged because I had a box up here. And when it came back down, I can grab that and take some profit. Or if it just stays up here above my box and expires, I lose my max profit. But again, I made some money because I took a long and I took a short. And that's that's pound yen. That may not be the greatest example because it's a more trending market. But NASDAQ has. So like right now, we don't really seem to be making higher highs. We'll see. Like if this bar closes, another bar closes down, we make a higher high, then you could go, okay, I'm starting to get into chop. Now it'd be a lot better if you had, and I don't have it plotted on that contract at the moment, or just because I don't have time to load it. But if I got ICE or settlement or other levels that we teach you, highs and lows of days and all the other stuff that we teach you in power plays, then I know I got a chop box. And the biggest thing that expedites the chop boxes is having these actual levels to go, I expect chop when I hit these levels. There are highways, there's going to be intersections, markets are going to slow down, and they did. So, and then it went up to exactly half a deviation implied deviation level. And notice the market went down to a low of almost exactly 1.5 deviations. So we had a 2 deviation move on pound yen. If we go over, we look at ES, barely moving at all. But you get one trade off. I mean, right now we're in chop, right? So you could definitely define this as chop area. So you go in and you could buy a spread or sell at a lower spread, buy it, sell when it gets up here, and talk about a way to play it. I mean, if we go back, let's just look at the ultimate chop box on it, S&P right now. All right, that's the last 8 days. So, I mean, it's in a choppy range. It may not be the perfect chop box, but it's in a choppy range. So seeing that choppy range, I could literally use that chart backed out with such low volume on it. I only have a 6-tick chart up right now in ES. And I could just play that, come in every day and go, okay, well, it's about at the top of the range. I'm going to buy a spread. And, oh, that's good. I'm at a, we zoomed way out. Deviations are like having a heart attack. There we go. But I go in and go, okay, well, I'm back near the top of the high again. I'm going to go ahead and buy a lower spread and go short. It comes down. Okay, it hit a settlement level. Take profit. So like anytime you hit one of those highs or lows when you're in a high of the market, especially the highs, then if you look at my consistent lows about right here, so I have a level near that, so 0.7. So at 0.7, I could buy a spread. You can use all these levels. You can get back up and look at the whole market. Don't just get stuck in power play mode. I love power plays, but I want you to back up. I want you to go, how can I make money while I'm bored? What can I do? What can I take advantage of? How can I make my power plays better by lowering my risk? Let's see here. Yeah, Josh would definitely take the ultimate hedge strategy, and then you can come back and watch this, and you'll see it. But the advantage of the ultimate hedge strategy right now is the implied volatility is so low, it's cheap that you can actually use daily contracts. I see, Chip, I mean on a signal, could you set a hedge once it passes risk? You, a trail. Yeah, I would wait till it passes risk before I trail, because I've already accepted the risk. So why get out? Like wait until you've passed the risk and you're in net profit, then you can start moving the thing up, right? Like why? Like I said, you're sort of bored just waiting. And if you see this kind of market, like get away from it. Either do what I'm talking about and go to even smaller tick sizes, okay, or go over and find something, that's moving. So NASDAQ has some movement there. Gold. Look at this gold, okay? We're moving. Like it's not massive, but it's enough to make a decent profit, in trade. So we got 1292, 12. That's 5 points. I mean, you're getting about 10 points easy on gold a day. So you get the right setup and you hedge it. You sit back, makes life a lot easier. Okay. Ron, they're in Ninja because TOS doesn't have the correct information to be able to do it. But I mean, you can always plot them on a TOS chart. So Most people just have Ninja open and load it, but you can go over and plot your levels. But if you're on TOS charts, you're not getting true tick data, which means you're not getting the volume that you actually need to read everything. And you're getting basically what's called snapshot prints. That's how they do all the free data. It's not true tick unfiltered data. And you're paying a lot more in commission. So, like if you're trading futures, you're paying a lot more than you would be trading at Ninja brokerage. Yeah, point of controls would be like ICE. You're not buying two when hedging futures, though, right? If I was going to be going short Nasdaq, I'd buy two spreads because I want it. You know, Nasdaq is $20 a point, and an AX spread on Nasdaq is $10 a point, so I'd buy two to hedge. Well, if I want to protect next day movement the night before, then I put on a daily spread in the opposing direction. To decide for profit side of spreads, I use power play systems that we teach. Joshua, exactly. Yep, as it's moving up and down, making the money on the proximity. Let's see here. Got the rich part. That would be awesome. The chop box basically just, if the market's going up and down, when it goes up, like when it goes down here, you buy the lower spread, and it goes up, and you take profit. And then you buy a lower spread, and you sell one of those near-the-market spreads. When it goes down, you take profit. And you already have your lower spread over here, so you buy. As it goes up, you take profit, and you just keep doing it and chop. To learn the ultimate hedge like laid out step by step, just go under education, and it's right there under Nadex. Replay will be available. Yep. Bias correction is based on the power play systems. The scanner is free, the deviation levels are free, and all the courses are free. The forums are free, and the webinars are free. The only thing that isn't free is the tools, because we have multiple full-time programmers that like to eat, and we pay them well to do a good job to make them for us. So that's how the scanner gets paid for. That's how all the tools get made. I mean, they're not contractors. Like, they're full-time programmers for Apex. So, Ben, DJ, and other guys that we got on. Austin overseeing, projects. But so the tools are not all free because they cost money to make. And we don't just make them, we continually improve them. And if you've been around, Apex for any amount of time, that's definitely true. Yeah, the volume bars that look sideways, that's actually what we call VAD, which is volume accumulation distribution. Makes some of the coolest signals in the world. And it's trend volume. It's not just volume of the bar, it keeps going with the trend. So it accumulates volume until the trend turns. At the top of the range, why am I buying at the top of the range? I'm buying a low risk spread at the top of the range so I can sell a near the market spread. And then near the market spread comes down, I take profit on it. Okay? So I can hedge on both sides. So you can look at it visually. This thing will let me do it without blowing up. But if you imagine like a box up here, and then a box down here, because I sold a low risk spread, and then I bought a low risk spread. And then what I'm doing is I'm using the near the market spread and going short, taking profit, going long, taking profit, going short, taking profit. Okay? So you have two low risk hedge spreads, one at top and bottom of box. Yeah. Yeah, even the night before. They start at 6 o'clock. Miles, you are awesome at webinars. I'm used to this type of being a sales job. So this is actual education. Glad I can help. So I love helping traders, and this is just my favorite strategy. And John was telling me, he's like, man, we got traders that are, having a hard time with the low volatility. And I'm like, I'm loving low volatility. He's like, can you do a webinar? And I'm like, yeah. So this is, I'm like, you just got to know how to take advantage of it. Definitely being recorded, Randy. John lets me do a webinar and I go for hours. How do we get the feeds for Ninja, Forex, Futures? All that is actually in the intro course for Ninja. We actually have a course that walks you through exactly how to set it up. Just look under education there. You don't need the Apex diagnostic bars to use the deviation levels. You can open 10-minute bars. Actually, I love 10-minute bars for volume spikes, but you just put the deviation levels on. They don't require the diagnostic bars. Just when you open a chart, go 10-minute chart instead of diagnostic bar chart. It'll work. So first hedge, then play ongoing. Yeah, you'll get breakouts, and you'll still have those hedges there. So when the market moves down, you may be able to use it again. You'll be able to find them on NASDAQ during the day to hedge with. It'll be hard to find them at night because the premium's so high. Just because the spread width is narrower. So that's why I sort of had to come in, because when I said, what do y'all trade? 80% of people said NASDAQ. So I'm like, okay, first let me show you how you make money in flat markets on NASDAQ. And then, okay, don't apply this strategy to NASDAQ. Let me show you the strategy for everything else. The variance between Nadex indicative quotes and TOS, that would not be TOS's fault. TOS is quoting the market at whatever speed they're allowing the updates to happen at. The indicative of Nadex is a settlement price, okay? Just like the CME has a settlement price every day on ES, or they take, and I'm just throwing out because they've updated the rules to make them better, but it's like they take all the trades from the last 30 seconds and multiply them times their volume, and then they take that, they sum them all together, and then they average them, and that's settlement. That's what indicative is. So the reason the indicative on Nadex is always going to be a little bit different than the underlying market is because it's using an average of the prices for settlement, so it can't be manipulated. So it's the exact same thing that CME does to settle every option. They can't show you CME's price because CME owns that data, right? But they can show you their indicative formula of that price. And that's why I tell people to trade on the actual market. Don't trade on the indicative. Trade on the underlying market. Don't use SPX to trade ES. Use ES to trade ES. And if you're trading US 500 options, you're going to look at ES, not SPX, not the US 500 indicative. If you trade Apple, you're going to trade calls, you're going to look at the Apple chart. So always look at the underlying market chart. Yeah, it's the settlement. Buy and sell settlement will always be the same because it's one price. And they're constantly calculating it because they have contracts depending on the market that expire every 5, 20, every hour, 6 hours, 8 hours, or day, or week. So it's a constant calculation. Right, you usually would not just put on the contracts at one time. You can, and if you do that, you're basically going straight into gamma scalping mode. So at that point, which isn't a horrible thing to do, Khalid, it's actually impressive that you're bringing that up. I'd want something more volatile than ES, but you go over here and find a market that's actually had a little volatility. I mean, you can put them on and then just boom, boom, boom. I mean, your first goal when you're doing this is to just cover your risk, okay, on your two spreads. Once you've made the profit of your risk on your two spreads, then as long as you buy below the spread that you sold, and as long as you sell below the spread that you bought, then your risk is covered. So rest easy, free, no additional risk trading, you know, once you accomplish that. Yep, cheap bottom, cheap bottom, go back and forth. Yeah, pound yen has some, I guess, I think it's probably one among, if not my all-time favorite as far as effect goes. And I don't even have this like optimized to what I would probably set it at, but I mean, 10 ticks is looking fantastic. And so even if you're not playing chop boxes, you know, you're getting like, you go trade a real market like pound yen at the moment. Like I said, there's always something moving. Like, you know, my go-tos are gold, oil, pound yen, and Russell or NASDAQ. So depending upon what I'm doing. Uh, so you get a signal, then, you know, let's say you go long, you have a signal over here. Okay. Let's get it like right here. Let's say we have a chop box, whatever, we get a signal to go short. You buy a spread to hedge, you go short. And there'll be a really good spread to hedge right there because that's where settlement is. Okay. So you buy that spread to hedge and you go short, short, short. I mean, nice trade. You trail it down. Let's say you're using, you know, my favorite method, which is just MVP without using OP on top of it. Okay. Like OP is my favorite way to, but MVP is my second because it gives me room to let things move. You just have to have a lot more patience and self-control. Because like you see this and you're like, ah. But you know, there's an APEX, so you get an Apex trade right there. All right, awesome. Go short on the E, hedge the trade with the 2-hour contract, and go short. And it's so much simpler and easier than binaries and playing all or nothing, and so much less stressful than just outright trading futures and forex and then to worry about stop losses. You can trade chop. You can put on your, you know, your trending trades. You can, you know, you can do everything with it. And there's just different ways to take advantage of it. But right now is the time because it's so cheap to get insurance. So if I'm selling anything, I'm selling like go buy cheap insurance because it's really cheap right now. These bars are what's called, I have a few bars that I made, but these are called diagnostic bars. It's sort of like it's not a range bar. It's sort of like what's called a Renko bar, but it's more accurate. It actually has a true like low and a true high and you know, true close, true open, and it actually pulls every single tick and it calculates based on break of session and break of weekend and holiday, and there's a lot of extra stuff behind the scenes. It's not just that, but what it does is when the market moves like so many ticks from the open, then it'll make a new bar. If it moves the opposite direction so many ticks from the open, it'll make a new bar. So I have another one called continuum that if it moves so many ticks up or so many ticks down or so many minutes have passed, it'll actually make a new bar because it's time and space. And it's so much better than minute charts. Like, why do you have, the only reason I don't get 10-minute charts is because I know institutional traders look at them just for volume purpose. Like, that's it. But why do you care that the earth is rotated so many degrees to have a new bar? Like, does it matter? Like, that's why it doesn't make sense for me to trade like 5-minute bars and 30-minute bars. And like, the earth rotated, so I have a new bar now. Who cares? Like, did the market move? Did something happen? So that's where diagnostic bars came from. If you have a clear directional bias in the evening, then yeah, you could place a daily trade. It's, you know, it's covered. You can set a trailing stop up. We have a trailing stop feature inside of the scanner. You can use it on intraday signals. You don't have to use the 2 hours. See, that's what I'm trying to tell you, John, right now is normally you would have to use the 2 hours. You can still use the daily on intraday signals because it's so cheap. I mean, we were showing 2-point stops on a contract that expires in like, you know, 18 hours. So just imagine, I mean, what are they gonna be, 1 point tomorrow morning, right? So why have a 2-hour contract when you have one that goes all day and you like have the risk there? The advantage of the 2-hour contracts is every hour they come out when they start opening up. On Forex, they open up now in the morning. They, you know, depending on the market, they start like at 8. But the advantage of them is you're more likely to have one with a floor and a ceiling close to where you want to hedge at. So, but if you have a daily and you can hedge right there, it's probably going to cost you very similar to the same amount of money. Maybe another point for like 6 more hours. Yeah, I'll pay the extra dollar, extra $10. Normally you'd have to use 2 hours, but right now you can use dailies as long as they're where you want the hedge to be. Yeah, we plot the settlement, and then we have the high and the low of the day. All right. Well, that went insanely longer than I expected, but y'all kept asking questions, so I'm just gonna keep feeding information. I look forward to doing more of these with you, maybe a little shorter, maybe some examples live as we're going and trading. Um, somebody mentioned doing a gap webinar and teaching about that. I used to trade gaps like every day. But give me here another 3 hours. I could too. I love talking and helping, and it's good for me because it refreshes. Like, people don't understand. People are like, oh, Apex. I'm like, I am 100 times better trader because of the community of Apex and all the ideas and feedback. And part of it started just me having to actually say out loud what I do. But then it also became feedback where I learn from other traders. They see things I don't even think of. And then let me check one thing for you before we all hop off. Um, let's see here. Okay, so one announcement, and this is the big bonus that all of you are going to get to find out that stayed on. Okay. Oh, and by the way, Lori teaching one market at a time is the right way to learn to trade. So don't feel like I'm saying that's the wrong way, just in case somebody starts to come back at me or she's like, why did you tell them? That is the way that you're going to learn to trade. Okay. But your next level is going to be able to take on different markets. And when you hedge, your mind is so much freer that you can actually look at the other chart. Because if your mind is not free and you try to trade multiple charts, like, emotions will take over and you'll be stupid. Like, all of us, myself included. If you just go for spread sources, John, literally just go to free education, go to Nadex, and you'll see Nadex Spreads 101, and you'll see the Ultimate Hedge course. Like, and there you go. Like, it'll teach you all the basics on spreads, and then how I apply the Ultimate Hedge. No, that's all you need. And I mean, I guess you could watch this like 5 more times, but it's really it's not. Don't let it become complex. It really isn't. It's buying something in the opposite direction with smaller risk, so that way you can make money if it goes in your direction, but you're not worried if it goes the other way. That's it. Don't make it more than that. L'Oreal and MB has made me better. Thank you, Marvino. Okay, so the bonus for all you who stayed on the webinar to the end. Okay, check out the things I showed you. All right, try them in demo. You greedy people, try it in demo. Okay. Remember not to be married to one chart or one instrument, especially during the slow times. When you put on the hedges, it will make it a lot easier for you to watch multiple instruments. Now, again, for you who stayed on, the game changer. I cannot wait to. The game changer is going to be the early detection hidden divergence indicator that John's been basically teasing you with while we've been, perfecting it. What's going to happen is you're going to be able to focus on your main instrument, i.e. NASDAQ or whatever it is that you've been trading, okay? But Other charts in the background can have the hidden divergence indicator on them. You'll get an audio alert. It'll work on futures. It'll also work on FX. That's the biggest thing we've been working on, is making it work on FX. Everything takes harder. It's harder to make it work on FX because we combine futures and Forex. And those alerts will go off, and then you can actually go look at that chart and see when a power play is setting up. So like if you wanted to do like what I said, like maybe you're watching NASDAQ, maybe you add NTF because it's a little more volatile, throw in oil, you know. You can have those in the background with the hidden divergence. That pops up, you can look it up, you can go, okay, I'm looking for a trade, okay, there's a chop setting up, or power play, you know, setting up, C trade setting up, you know, whatever. And you can also find your spread and have a little, again, advanced, sometimes it's 20 minutes, sometimes it's 4 minutes, but advanced notice. And so all that's coming out, you're going to love it. And it will help you a lot during the slow times, because again, it will help you watch multiple markets without having to have your eyes glued on the screen, which drives me crazy personally. And you should actually see an announcement tomorrow, and actually have access to it tomorrow. So we'll be blasting it out on social media, in the room, etc. tomorrow. Like really tomorrow. Thank you for all those who were patient on it, but I want to do it right. Like we figured it out, we made it work, but we had to make sure it really, 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 really worked. You know, I don't just want to release something so we can be like, oh, you got a tool. Like, okay, this is doing what it's supposed to do, where it's supposed to be doing it, and we're testing it on all these different markets and making sure it's working like it's supposed to work. And it just took a little longer, especially to make sure it works on FX. So I'm going to do it right before I'm just going to throw it out there. And we also had to put a little time aside to upgrade the order prints for you. I felt like that was a little bit more of a priority, so the programs had to, you know, hop on there. There will be either a webinar or there will be a training on it, like a post. So order prints, you know, came first. We got that done. It's done. Programs went back to getting hidden divergence, early hidden divergence, which is massive, and you will have it tomorrow. The alert feature will make a sound, and it'll also be in the alert box. So, and it makes your chart flash as well. So your chart will flash. It'll say early hidden divergence on pound yen. So you can know to go look at that chart. And then if you have I usually don't have the alert box up. If you have the alert box up, because like, which one did it say? Then you can go look at the alert box, or you just, like your chart, like that border, like the gray border there will flash. Like it'll be blinking, like dark gray, light gray, dark gray, light gray. And you'll know that you just had an alert go off. Nope, you don't got to tweak anything to get the alerts. I mean, there may be, I think we'll have the alerts turned on by default. So the video will go over exactly how to set the alerts. But I mean, it'd just be like alerts, true, false, like all the other ones. Yeah, there's no like tweaking, no like setting. It's like either it's on or it's off. And the video, like there will be a training video, I've already confirmed, done with it when it's released. You're welcome, Carl. Glad you're on with us too. You bet, Ed and Keith and Ray and Mike and all you guys been around a long time. A lot of new faces too. Awesome. Well, I'm glad y'all learned a lot, and now hop in the community and help each other master it together. So, you know, y'all got your mentor groups and everything, and own it. Okay? And if you're ever trying to figure something out and you can't get the answer, you know, Lori will get a hold of me. All right? Let's see, question. Is it for Ninja only, Khalid? The tools are only built in Ninja because I could spend 5 times the amount of money and make them in like TradeStation and Ninja and this and that, whatever, Genesis and whatever. But that also means the cost would have to be a lot higher because we'd have to have more programmers. We'd have to update every time we make a change. We have to make it like across multiple platforms. So we decided to go with one platform. You don't have to trade at Ninja to use it. I mean, like the Nadex traders are trading on the scanner or the Nadex platform. So you can trade wherever you want to. Now, if you're trading futures or Forex, I think Ninja's a great place, especially with their rates and the speed of execution that they have. But you don't have to trade. You can still like trade on TOS or TradeStation or MetaTrader 4. Personally, I don't like MetaTrader 4 because the brokers can see the other side of your trade, but it's a different discussion. But you can trade anywhere. Just think of it as a tool, and don't let a tool get in your way. Like, I want that tool, but this is what I like using. I have went through so many platforms because at the end of the day, I really don't care what tool I use. I care that it works. So, to answer your question, is you can trade anywhere, but the tools are built into Ninja. Recording will be blasted out everywhere. It'll be put in the forum, so you can watch it. So make sure you're following us on Facebook, facebook.com/Apex Investing. It'll also be put in the forum. It'll put on Twitter feed at Apex Investing. We'll put it everywhere, so you won't be able to miss it. It'll be in the Nadex spread webinar section as well, which is in the education Nadex spot that I showed you a little bit earlier. But really, the hidden divergence is like a massive game changer. And I can't wait for y'all to have it and hear your feedback. So, because it's going to make life so much easier. But y'all have a fantastic evening, and kudos to those who, stayed on for the marathon. And I hope you learned a lot from tonight. So, y'all are very welcome, and y'all have a good evening. Get engaged, okay? Get engaged in the rooms. Bye.